you can see the point that as long as it is gold-backed, then as long as you can exchange it into gold, no fiat currency can stand up against that. It then means that, if the ruble did it, the dollar would be, it would be toast. It really would. And apart from anything else, it could set off a tsunami of reserve movement out of fiat currencies into gold. As soon as someone presses the trigger and says, right, here is our gold standard, and assuming it's put together credibly, then fiat currencies is the end of them.
Alasdair Macleod, the founder of goldmoney.com, argues that the value of fiat currencies, such as the US dollar or the euro, fundamentally relies on people's trust in the government that issues them. If people lose confidence in the government's ability to maintain the currency's stability, they may become less willing to use it, decreasing its value. Various factors, including high inflation rates, large government deficits, or political instability, can trigger this loss of trust. This stands in contrast to a gold-backed currency, where each unit of the currency can be exchanged for a specific quantity of gold. Gold has traditionally served as an effective safeguard against inflation, as it tends to preserve its purchasing power over time. When a currency isn't backed by gold and isn't easily converted into gold, its value is determined by market sentiment and trust, not a fixed standard like gold. As a result, fiat currencies can lose value over time due to factors like inflation or changes in market confidence. Regarding the importance of a currency being backed by gold or readily convertible into gold, Macleod highlights that such a gold-backed currency provides stability and confidence to the market. Since the BRICS reportedly plan to back their new currency with gold and other metals with intrinsic value, like rare earth metals, interest-paying assets denominated in the BRIC would resemble interest-paying gold. It could make the assets denominated in the BRIC attractive to investors who want both the interest-bearing property of bonds and the diversifying properties of gold. When a currency is backed by gold, it effectively prevents the depreciation of its purchasing power. We will now bring you clips from Alasdair Macleod's interview with Liberty and Finance. But before we do, if you want more videos like this, hit the subscribe button and turn on the notification bell for more updates. Thank you and enjoy the video.
How is a fiat currency valued? A monetarist would say it depends on the quantity in circulation. But no, it's actually, America came up, I think it was something in Congress about something completely different. Full faith and credit in the US government. That's it. And if the faith and credit, evaporates, the currency evaporates. It's as simple as that. And if you look at the difference between many of the currencies in the emerging markets and the dollar. The dollar is obviously king of all the fiat currencies. But where, let us say, an emerging market economy is run on better lines than the US economy, at least from a credit point of view, what happens to their currency? It just goes down the pan. Why? Because if anyone's going to have any faith and credit in a currency, it is going to be in the dollar. It's not going to be in some minor country where you don't really need to hold any of that currency anyway. If you get some through trade, you just immediately flog it into the foreign exchange markets. You might hang on to the dollar because, you're going to be doing other business which requires dollars, sort of thing. So, it was a point that Ludwig von Mises made about the errors of, monetarism. It's completely wrong. It actually, a currency depends where it's fiat. If it's not backed by gold, if it's not readily convertible into gold, its value depends on what the markets make of it, the faith and credit that the markets have in that currency. It's got no sheet anchor. It's not tied to anything. Now, as soon as you get gold in there, as soon as you have a credibly backed, a gold-backed currency, then, you can have that. In fact, for years and years and years and years, nobody in Switzerland bothered having any gold coin or anything like that, holding any coin, because they had the faith that the central bank would hold sufficient reserves that they wouldn't have to do it themselves. Now, things have changed a bit, I have to say, in recent decades there. But you can see the point that as long as it is gold-backed, then as long as you can exchange it into gold, no fiat currency can stand up against that. in terms of the exchange rate with the fiat currencies, most of the effect will be on the decline in the purchasing power of the fiat currencies. Remember, the purchasing power of gold holds steady over time. I mean, if you look at the price of oil, in rubles, for example, I put together a chart, which I haven't got in front of me, but it's, I think it was something like around about, a barrel of oil was about 2.03 grams per barrel back in 1992. It's currently 1.4. So it's fallen in terms of oil. But in rubles, it's gone up over 7,000 times. Why? Because the ruble has lost its purchasing power. I mean, 7,000 times. So I think it was 7.5 was the actual figure. Well, the chart will be in the article, so you'll see it there. Fiat currencies, I'm afraid they're toast. As soon as someone presses the trigger and says, right, here is our gold standard, and assuming it's put together credibly, then fiat currencies is the end of them.
The banking system faced significant challenges earlier this year due to the failures of three major banks, Silicon Valley Bank, Signature Bank, and First Republic Bank. While these failures were primarily caused by issues within these institutions, such as over-reliance on specific funding sources and inadequate management of interest rate risks, the fear of these failures spreading to other banks created a period of anxiety for depositors, investors, and regulators. What has been particularly worrisome for the banking industry is the impact of rising interest rates. As interest rates go up, the cost of obtaining deposits and other sources of funding increases. Simultaneously, the fair value of investments in fixed-rate securities tends to decline. Macleod predicts that banking difficulties will resurface in the near future, and he identifies rising interest rates and bond yields as the primary drivers. Banks, recognizing the elevated risk levels and the potential for an impending economic downturn, are becoming more cautious and are scaling back their lending activities. Macroeconomic statistics may not fully capture the onset of a recession, but Macleod believes it's underway, driven by contracting credit quality. Banks, heavily leveraged on their balance sheets, are pulling back credit, essentially contributing to a recession. Let's get back to the interview.
I think the first thing I should say is that the authorities do place a huge, great importance on ensuring that no depositors lose their money. I mean, apart from anything else, the FDIC, which insures deposits up to, was it $150,000 or
$250, yeah.
Yeah. I mean, it hasn't actually got the funds to deal with a widespread banking crisis. So banks will be rescued. Now, having said that, obviously, it would be a very, very worrying time if we have a resurgence of banking problems. Now, I think we are definitely going to have that, unfortunately. And the reasons are really revolve around interest rates and bond yields. I think there's a sort of widespread belief that apart from maybe another 0.25% or so, the rise in interest rates is now coming to an end, and it will be followed by lower interest rates through 2024 and into 2025. The fact of the matter is that we are in a credit crunch, a credit crisis where credit is being restricted. You just look at everything. I mean, the way in which money supply is behaving, by which we mean credit, basically, bank credit. Look at the sort of surveys, if you like, of lending officers, which is one of the better statistics that comes out of the St. Louis Fed. They're all pointing the same direction. And the reason for this is that banks are over-leveraged on their balance sheets. They see risk. They do not want to extend that risk which is mounting with the prospect of recession coming around the corner. I mean, I know we've been waiting for this recession, but it is happening. I mean, the problem is that statistics don't really capture the information. But if you just follow your nose, you can see that, yes, this recession is definitely beginning. And the driver of it is likely to be the contracting bank credit. So you've got this situation where banks are withdrawing credit because they're over leveraged, and they are guaranteeing that there will be a recession. The other problem is that with this continuing credit crunch and the fact, and I would say this is a fact, in anticipation of it happening, that inflation, as it were, measured by consumer prices, is not going to diminish in the way which markets expect, then interest rates are going to continue to rise. Now, under those circumstances, rising interest rates will also undermine stock markets, bond prices in particular. So you'll find that banks will try and get out of long maturities. They'll get into very short maturity treasury bills, that sort of thing. And you're bound to have banks failing along the way. And it's interesting to see that the Fed's facility, whereby it takes in US Treasury and agency debt at par, and then lends the bank, rather like a sort of extended reverse repo, cash instead at par value for 1 year. 1 year, bear in mind. I mean, it'll obviously be rolled if the problem continues. Then that's beginning to increase again. So, and if we look at the yields on bonds, I mean, they've backed off from the very, very high highs which we saw very, very recently. But this feels to me very much like, something temporary. And it's not going to take very much to drive 10-year maturity government bond yields significantly higher. So this is a very fragile situation, Dunnigan. And I think that on the next rise in bond yields, in particular, you'll find that this banking crisis will get into another phase.
Given the ongoing devaluation of fiat currencies worldwide due to escalating inflation, gold, widely regarded as a reliable hedge against inflation, is expected to maintain its appeal. This anticipation of continued devaluation is why we witnessed gold reaching new record highs earlier this year, reflecting the enduring attraction of precious metals as a store of value amid uncertain economic conditions. Could a gold-backed currency offer more stability in today's financial landscape? Share your thoughts in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.